Hey guys, Tim Albrecht here. And before we get into today's episode featuring Rich Delgado from DLP Capital, I want to let our listeners know this episode is not intended to serve as an endorsement for DLP Capital. The content in this episode is for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor and or tax professional with respect to any investment decision. Furthermore, the co-hosts of this podcast, Nate Hedrick and David Wright, are not associates of your financial pharmacist. All right, here's David and Nate with today's episode.
Welcome to the YFP Real Estate Investing Podcast. I'm Nate Hedrick.
And I'm David Bright. We're both pharmacists and real estate investors that believe that real estate investing does not have to distract from a meaningful career in pharmacy.
Each episode, we share stories that educate and inspire pharmacists to leverage real estate investing as a part of your financial plan. Hey, David, how's it going?
Hey, good, thanks. How you doing, man?
Good. We just got done with a really good episode, something that, again, in 120 episodes, somehow we have not covered yet, which is really cool. So a new avenue for us is always nice to find. And this time we got to talk about, investing in private real estate funds, which is similar to things we talked about, but wholly different. And so it was a nice change for us.
Yeah, Rich Delgado of DLP Capital talks about how some pharmacists or some people in general like this team approach to real estate investing. Pharmacists are definitely one of those, as we kind of don't love risk, and so we love pooling expertise and pooling people into a deal in order to reduce that risk. And so what this model differs in is, rather than investing in one specific project where then you are tied to the success or failure of that specific investment, instead this is a fund that puts multiple different large real estate projects into one giant fund so that you're averaging all of those returns out.
Yeah, and I really like how we walk through with Rich how this can compare and contrast with like a syndication or even like a public REIT, and just how it toes that line between those two things to be something that's different, unique, and all the pros and cons that go with that. We cover a lot of that in the episode.
Yeah, and I think Rich brings something really relatable in this, in that he's not one of these folks that was on a job site swinging a hammer for 20 years, right? Like he had a finance background, found a love for real estate and how that had potential benefit, and then found a way to invest in real estate without having to be active and in the trenches. And so I think that fits for a lot of pharmacists that, not too many of us are going to be hanging drywall tonight. So I think that could be a really good fit for pharmacist investors as well.
Yeah. And I think the other cool thing is, just to round it out, is that he talks a little bit about how it's not just about investing, making money off of things. It's impact investing. How do we take and make the community a better place? How do we take and make housing a more affordable thing for people? So it's a refreshing take on kind of the standard line of a syndicator of like, here's how much money you're going to make. It's a different take on that of like, here's how we're going to take and protect your investment and then also contribute to the community growing itself.
Yeah, and that's why we're just really excited to bring this one, especially to an audience of pharmacists that love safety in numbers and teamwork and doing something positive with the investment, not just numbers on a spreadsheet.
Yeah, for sure. And then we want to hit pause before we go to the episode, because again, Rich's episode is great. But before we go to that, want to remind you guys again, re-announce rather that we've got a webinar coming up really soon. If you're hearing this right now, it might be going on, right? So it's October 7th at 9 p.m. Eastern. So make sure you register if you haven't already. We're going to dive deep into David and I's other entity, Aliquot Investing, and really talking all about how syndications work, right? Syndication 101. So if you haven't registered for that yet, you can do that right now. Go on over to yourfinancialpharmacist.com/syndication, and you can get registered for that webinar that's coming up, again, just right around the corner.
Yeah. So on that webinar, Nate, you and I will be talking with Alex Cartwright, who's a guest that we've had on past episodes. He's an economist who's led syndications. And so with that economist hat on, he can talk about this big picture and what that looks like, as well as some of the nitty-gritty terms and details that are really helpful if you're evaluating syndications like this. And then even talk about a project that Nate, you and I have invested in personally.
Yeah, that's big for me. I think, talking about this stuff broadly is great, but it's really nice to dive into the details from somebody that's actually doing it. And again, you and I are
Mhm.
actively doing it right now as Aliquot
Mhm.
Group. And so it's just a nice way for us to dive into that and kind of share with our audience about how this is actually going.
Yeah, and again, I just love the how it fits the pharmacist values teamwork like this because we're looking for safety oriented investing, and that's why we wanted to highlight approaches, whether it's in that webinar, in today's episode, that may be a good fit for pharmacists based on their specific real estate goals.
Yeah, for sure. All right, lots of ways to learn more about real estate, but we'll take you to the next one in front of you, which is the episode with Rich. Here you go. Hey, Rich, welcome to the show.
Hey, gentlemen. Thanks for having me. It's a pleasure to be here with you.
Yeah, this is great. You and I got a chance to talk about a month ago, and we're really excited to have you on today to talk all about DLP Capital and all of the stuff that you guys are doing today. I guess, just to get our audience started here, can you give us a little background on yourself and why you're sitting down with us today?
Yeah, certainly. So I'm a managing director at DLP Capital, which is a private firm that deals in real estate. And we do three primary things. We buy real estate, we build it from the ground up, and we lend to other real estate operators that do the same thing. So we manage investment funds that allow investors to come in and passively invest in all of those strategies. So we give them a little bit of everything to kind of choose from or choose them all, which many of our investors do. But again, spent about 30 years of my career in structured finance before joining DLP. I've been with the company now 5 years. Before joining DLP, I also was not a real estate investor, but was very interested in real estate. And again, found DLP to be a great passive investment for myself, and finally joined the firm and became a member and an employee as well.
I love that. I think there's a lot of what you're saying that resonates with pharmacists, right? Like not a real estate investor yet, but fascinated by it. I think there's a lot of folks that like passive because a lot of us have seen a house flipping show or two on TV, and there's this feeling that, oh, I have to be in there painting and I have to own a hammer and I have to do all these things that feel like real estate investing. But I think what you're saying is it's not the case. You can be a real estate investor, but you don't have to be hands-on to do it.
That's exactly right, David. When you look at it, and I must say the temptation is there, right? You always say maybe I'm missing out on something if I'm not doing it myself, if I'm not controlling every aspect, right? But the reality is, owning real estate is hard work. Not just hard. Um, you can lose a lot of money doing it if you don't do it correctly, right? So if you don't know what you're doing, it could be costly, and rather than being a good investment, it could turn out pretty poorly. So I like to think I have my strengths, right, in what I do as a structured finance professional, and I raise debt and equity for the company. So that's my expertise. I don't go out and try to, invest in the properties or, do all of the property management or the maintenance. We do that all as a company. But again, I like the fact that I can put my money at someone like DLP and they do everything. I don't have to take phone calls in the middle of the night because the plumbing is broken, right? Or anything is going bad. And I have diversification. I have a lot of other benefits that we'll talk about that come with fund structures. But yeah, it's nice. And believe it or not, I'd probably have to say, if I had to guess, more than half of our current investors are former real estate operators, meaning they did do it at one time, right? Whether they did it for a short period of time and just said, not for me, right? I'd rather not be swinging the hammer and doing all the things or running a construction company, or they're retired from it, right? They're like, I don't want to do this anymore. I do want to continue to, be in real estate because I love it, right? They know there's money to be made, and if done well, it could be very profitable. But they just say, you know what? We found DLP. They're a good operator. We can invest in them and let the experts do what they do best. And you know what? I'll sit back, earn a double digit return, which isn't too bad, right? Not too shabby, and just collect your, and some people call it mailbox money, where they're just, getting a little extra income. And for others, it's retirement. We have folks that span all ages, and some of them just put in, a few $1 million. They've created a nice little nest egg. Now they just live off of it. They get a nice monthly income every month and, get a paycheck. And so it works out well for them as well.
Yeah, I think there's a lot of folks that are active investors that have had that messy move out, or they've had an eviction, or they've had that maintenance call in the middle of the night, or they've had those experiences that make them definitely long for that mailbox money and that kind of passive approach, right? So I think of when I hear that mailbox money or that passive investing, I think of things like publicly traded REITs, I think of syndications, and then I think of private REITs or private funds, which is more like what you're describing here. But could you just big picture walk us through what those different models are and how those differ from each other?
Yeah, sure. That's a great space to go to. So, maybe we'll just frame out the differences between them in terms of what they are, and then we could talk
Mhm.
about the pros and cons of each of them, right? So, first, let's start with your public REITs, right? Which are very different animal because it's almost like equity, right? Even though you might have assets behind and everything, the valuation of your investment fluctuates with sentiment, right? What people truly think the value should be, shouldn't be. And so, not very different from an equity investment, in my view, even though it's real estate related. Then you have syndications, which are typically going to be single one property investment. So, again, whatever asset class, let's just say it's a multifamily apartment complex, right? You're investing in that one property, and there may be, another dozen or plus investors in that syndication with you, right? Everybody's making an investment. The risk there is, you're taking the chance that that one property is either going to do really well or it's going to, maybe break out okay. In many cases, and unfortunately, I take a lot of these calls, it's investors that say, oh, I should never have invested in that syndication because I lost all my money, right? And that can happen, unfortunately, especially in today's environment from real estate perspective. And then you have what we call the private real estate funds. And again, that could be in the form of a REIT, doesn't have to be a REIT, but a private REIT, very different from a public REIT, right? So all of our investment funds are private REITs. All they do is give you a preferred tax election and give you some benefits from a tax perspective. But the fundamentals are very much like the syndication in the sense that you are getting the benefits of the direct investment real estate. And in real estate, the direct investment, you get the tax benefits the way, if it's structured correctly, the way we've structured, and we'll talk about that. But you get the benefit of not being just solely in one property. You're backed by all the properties in the fund. And that's the beauty of a private REIT that has a fund structure. And again, there could be other benefits like, the pass through of depreciation. There could be benefits of having just a evergreen fund, for instance, which we can talk a little bit more about, right? Where you don't have to worry about investing your money and then getting a return of capital, maybe at an inopportune time, right? If you do get capital back, right? So there's some benefits to the longevity. So a lot of benefits, mostly diversification, geographic distribution. So if you have something go bad with a single property, typically the effect of that is going to be minimal on your overall returns versus, taking those big, swings where you might make a lot, but you could lose it all as well.
It sounds like that's the major difference too, in terms of like the pro that people would think about, right? Is like the syndication has that higher upside where like if it goes really well, right? Where like if I buy this individual apartment complex, if it goes really well, I could make 40, 50, 60% returns. Whereas you don't have that high ceiling on some of these private REITs, but the lower floor, right? You've got this kind of protection built into it with the diversification. Am I interpreting that right?
That's exactly right. And I'll give you a good example. So we have an investment fund. It's called DLP Housing Fund. It's where we invest in existing real estate. So we go out and buy existing apartment communities, renovate them, improve them for the benefit of our investors and for the residents, right? Really building thriving communities, which is at the heart of what we do in our impact investments. Um, to your point, right, Nate? You can get oversized returns. So in 2020, we just, COVID hit. We had a couple of assets under contract. Again, with the market being what it was, we were backing out of some of them. They kept coming back. We really want you to buy these assets. So we wound up buying things at a really big discount because we were able to negotiate given the market environment at that time. And at that point, we were under $1 billion of assets under management in 2020. the asset that we bought, a property called Port Royal, put us over the 1 billion of AUM. That single property, it was originally a $60 million check. We got it for a 10% discount, paid $54 million, sold it 16 months later for $90 million. So again, 140% return, really great. But the benefit to the fund, right? That year, investors in the fund made a 45% return. Now, we don't say that's what you should expect, right? That was a great opportunity, great times. But to your point, you have that downside protection, but you still have all of the same upside, right? You can make really great returns.
I think that sums up nicely some of the pros and cons about this type of fund. I know one other thing that I hear about this type of investing in general is that it can be inaccessible to some when we talk about things like an accredited investor or investment minimums and things like that. It's not like I can go to the bank and open up a savings account and put $100 in. This is a very different animal. So can you walk us through what an accredited investor is and what that means, and then what typical minimums are for whether it's a syndication or something like this?
Yeah, absolutely. And our funds, not all funds are created this, but our funds are for accredited investors. And that's really more for the investors' protection, which means they know what they're doing. They're a knowledgeable investor. And typically the SEC is the one who dictates what that means and what the definition. The two most common definitions are the income and the net worth test. So the income test means that as an investor, you have either 200,000 of annual income for 2 years in a row, and you expect to continue to do so, or you have 300,000 jointly with your spouse. So again, same rule. The other test is, and it's an either or, not both, is you have 1 million of net worth, and that is excluding your primary residence. So you can't include that in the calculation. There are a lot of firms where you can get that. There's an attestation that typically investors give that they're accredited. We ourselves require it to be a third-party attestation. So from either an accountant, an attorney, a financial advisor, someone that's licensed and can attest to it. But there are other firms out there that you can go to as well, online firms where you can just upload documents, Verify Investor, InvestReady, and others, which a lot of investors use. But again, that gives investors a protection, knowing that they're knowledgeable investors and getting into these funds. The other side of it is what you brought up, David, on the minimum, right? Funds are structured differently, and some have lower minimums, some have higher minimums. All of our funds are 200,000 minimum, but that's again because we have limited slots within the funds themselves. And so, if we were taking in $10,000, $25,000, we'd chew up all those slots, right, within the fund pretty quickly. So really, we set that minimum as a threshold to get in. Once you're in, you can add as much or as little as you want. You could stay at the $200,000 investment, or you can add, 5,000, 20,000, 200,000, 200. Again, whatever you want to do, you can add at any time. And then we'll talk a little about this because I think it's an important topic when it comes to looking at fund structures, liquidity, making sure you have the access to liquidity, which is a big difference when you're talking about syndications and funds, right? A syndication, you're typically locked into that investment for the life of that deal. And that could be 3 years, 5 years, 7, 10. I've heard of all different types. And there are funds sometimes that will lock you out the same way. So you just have to know what you're getting into, understand the liquidity requirements. Our funds are structured where you always have liquidity. In our equity funds, which are where we're investing directly in real estate or building it from the ground up, you have annual liquidity, so you can get out in whole or in part every year. Or our debt funds, which are very, very liquid funds because there's so much velocity, short-term lending, that we offer 90-day liquidity. You can get out at any time with 90 days notice.
See, and that's huge. I'm really glad you went there, Rich, because I think that's something that is not often talked about with a lot of these, especially like a syndication, like you said. If you're going in with even if it's 100 partners and you're buying an apartment complex, right? It's 200 units and they're going to rehab it for 2 years and then so on. You are essentially locked into that in almost all cases until they sell that or refinance it. Like that's it. Like you have to have your money in there. There's no selling your shares to somebody else. So I think that's something that's really important for you to ask about if you're going to invest in something like this. How liquid is it, right? This is very different than buying a stock, right? If I go and buy an equity, if I go buy Apple, if I go buy Google shares, I can sell it tomorrow. I can sell it 5 minutes later, and there's someone else ready to buy it, right? That's not always the case with a lot of these funds.
That's exactly right. And along with that is another issue which folks don't talk a lot about, but is a real big issue, which is the capital calls, right? So again, in our funds, when you make an investment, that's all you're making, right? We're not coming back saying, hey, David, we need another, 50,000 or another 200,000 from you in order to make this deal work because it's requiring more money because whatever, XYZ, right? And you hear that all the time. Folks are like, yeah, I don't know what to do because if I don't put the money in, right, I've lost my investment. And you don't know if you're throwing good money after bad. And so that can be another issue. You just, as you're going in, doing your diligence, understand, are there going to be capital calls in the future? Are you going to be required to put any more money in? We do not ever. We've never had that type of capital call. The only time you'll hear us talk about capital call is if you make a large investment of 500,000 or more. What we'll do is before taking your money, we'll give you a call and say, okay, rather than waiting a month till we're ready to deploy it, right? We'll call you right before we're going to put the money to work, and then we'll call you capital. We don't call portions of it. We just call the whole thing. We put it right to work and deploy it and make it, start earning.
I'm glad you went there as well. I remember buying into my first syndication and sitting down with my lawyer to like review the documents. And he was like, these are like the top 10 things you got to know. And just before you buy this, right, Nate? And I remember the capital call section is like, look, here's what happens. Like they can ask for more money. And here are the 5 things that transpire after that. Like either you can bail, you can, accept that you'll have less shares in the overall syndication. Like this is what it looks like. But it's like, man, that no one ever talks about that on a podcast. Like, why is that not in there? So it's good. Like, this is the stuff we have to be talking about because if people are going to look at this as a way to diversify their retirement or their, just their asset class, like there are repercussions and there are ramifications to doing that. You have to approach it the right way. So I'm glad we talked about that.
Yeah, no, super important. And you know what? You can always tell the difference between entities first by their transparency, right? So I urge every investor, definitely do your diligence, call, right? Get to know the company well, ask a million questions, right? Like if they hold back, if they're not sharing documentation with you, if they're not giving you financial statements, if they're not giving you asset summaries, loan tapes, right? Like the information you need to make an informed investment decision, bail. That's just bail. There's no reason to continue the discussion further, right? Because transparency is the first and foremost, the crux of it all. So we see and know so many, and I mean, as an investor, right? I've gone and tried to get loan tapes from firms to look at debt funds. They won't give them to you. I'm like, okay, thanks, but no thanks. So, not an investment for me, right? I want to see what the underlying assets are. I want to know what the maturities are. I want to know again, who you have money, like you just want to know. You want to know what the properties are. You want to know what you paid for the properties. You want to know what the value of the property is, what, the LTC, the LTV is. You want to know what the debt on the property, like you just want to know all the data, right? Because if you're investing, I mean, if I'm putting my money in it, right, I would want to know. So we make all of that available to our investors.
So I want to, because that's really interesting, right? So we kind of kick this off with like, this is easy. It's passive. You just buy this thing and it gives you 10%. And then you just threw like 50 acronyms at us. Right. And what it's quickly sounding like, and I just want to talk about this is like, I go to my financial planner to help me buy equities, right? To buy stocks. Like, can I go to a financial planner and they'll like say, oh yeah, go to DLP and buy this fund? Like, is that common or that you have people doing that? Or like, who's helping people navigate this so that I can just turn my brain off and give you, 250 grand and expect returns? Like, what does that look like?
Yeah, and that's a great question. So when it comes to the institutional side, registered investment advisors will help their clients, right? And they will let them know whether they've done diligence themselves or if they use a third party diligence firm. So like we have fact right due diligence, right? So there are parties that do diligence and write reports for these advisors. And, we've gone through a myriad of different due diligences. We also have some that we can share publicly, right? So that's another one. You can ask your investment firm that you're considering, do you have an audit report or do you have a due diligence report you can share with me, right? But that's the best way because, again, you may not know all the questions to ask, but you know what? These third-party diligence firms that do this for a living, they know what to ask. They know what the issues are, and they'll point them out, right? The diligence reports are very concise. They're accurate. They point out all the risks, things that are done well, things that aren't done so well. They compare to other funds. So that's a great way to do it. And getting that kind of information is, again, another one of those questions just to ask. Do you have a third-party diligence report you could share with me?
Yeah, that's great. That boils it down instead of like, what assets are you buying? I just want to know, like, what's my return look like? How do I do this?
Yeah, exactly. And again, do you pass, right, the test, or do you not pass the test? Again, some folks do things very well, some, well, not so well.
Yeah. When we talk about the upside of real estate investing, it sounds like you're harnessing a lot of the things that translate from the single family rental space. I think a lot of folks listening are probably pretty familiar with the single family rental space. You think about the cash flow of rents, you think about the building going up in value. Those obviously tie in, but at a much larger scale because you're talking about larger properties. One thing that feels very ethereal and confusing very quickly is the tax benefits. I think everyone tends to know that there's tax benefits, especially with single family or multifamily. There's depreciation, things like that. But how do tax benefits fit into an investing strategy like this?
Sure. And I'm going to come to that right away. I just want to answer one thing because I realized Nate brought up all the acronyms earlier, and we were talking about LTV, loan to value, and LTC, loan to cost, right? Two very different measures, but both very important, right? As you're looking at what that loan is, right? When you're comparing it to the value of the property once it's repaired. But then there's also what's the loan to the cost that you acquire the property at, right? And that's a more meaningful one because what you want to know is that the investor or the borrower you're lending money to has skin in the game, right? And so you want to know that that's in there. Our loan to cost is generally going to be in the high 70s, which means there's going to be 20% plus equity behind it, right? Which is very meaningful in this space. And then going to the tax benefits, right? Again, each asset class is a little different. First, we do, again, for DLP at least, we're in the what I'll call residential space. And that could be some single family where we build, brand new single family communities from the ground up for rent. Almost everything we do is build for rent. We do some small stuff for sale, but most of it is build to rent. To your point, really looking for cash flowing assets, looking at generating strong net operating income, right? The majority of our communities are going to be multifamily communities. And our sweet spot is anywhere from 200 to 500 units. And what that means is when you're investing in real estate directly, so our housing fund is our most tax efficient structure because that's the one that passes through the depreciation on existing real estate. For instance, we have another fund that's direct investment in real estate, but it's ground up construction. So we're moving a lot of dirt. There's a lot of pre-development work, a lot of development work, right? And then we're going to start going vertical. We're actually in the process. We have about 10,000 units that we're building in our Building Communities Fund. There's no depreciation, right? There's nothing to pass through because we don't have buildings already erected that we're going to start depreciation. Once we get those built up, then we'll start depreciating them, passing that through. But there'll always be new construction and new development going on. So it'll never be as tax efficient as our housing fund. For instance, our housing fund, which is all existing buildings, right? And we have 55 properties in there and continuously buying new ones, selling, stuff out. That fund, since its inception, has done about 19.5% on a return basis pre-tax. Every year, we've been able to offset 100% of your ordinary income, which is what I'll call realized gains, right? So any kind of income from rents, any kind of income from sales. So that realized we've been able to offset 100%. Now, you have to be careful, right? And good questions to ask is always consult a tax advisor. That's the first thing, right? Because they'll know what to look for. But we use cost segregation versus accelerated depreciation, which is meaningful also because you don't want to get stuck with depreciation recapture, right? So with cost seg, you don't get that recapture. We're truly offsetting that income. So that's a super tax efficient structure. And then the only thing we have is on the unrealized gain, which is the appreciation in the property itself. That is a capital gain that just gets deferred in perpetuity within the fund because we do 1031s within the fund, 1031 exchanges of like kind properties. So that is super tax efficient because now you're not paying any tax. You're deferring all your capital gains to the end. So great structure. And then there is this small little thing called the QBI, Qualified Business Income Deduction, which is a 20% tax rate deduction. That's something that you benefit from and you do not get phased out. Under normal circumstances, high income earners get phased out over a certain income level. But with REITs, you do not. So being a private REIT, you get the benefit of taking the full 20% tax rate deduction. So let's just say you're at the highest, 36, 37%, it would bring it down to roughly around 29%, right, on the tax. So again, very, very, very tax efficient structure.
What does that look like as an end user? So if I'm doing my taxes at the end of the year, like, do I have to understand all that, or am I getting like a form that I give to my accountant? Like, I just briefly, like, what does that look like for somebody that's actually getting this?
Great question. No, that's a very important question because you know what? You don't want to scare people and think, oh my goodness, what am I going to do with this, right? Super simple. So first and foremost, another one of those great questions to ask when you're looking at different investment in different funds is, what kind of tax form am I going to get? Am I getting a K1, a 1099, right? Second, do you issue your tax forms on time, right? That is so important. We have, knock on wood, always gotten out our tax forms, our K1s, by the end of March. So meeting the deadline. So we've never missed it. And I have to give all the credit to our accounting team. They just do a superb job of there's a lot of properties. You're getting a lot of information. You're going through a lot, but we have always issued them on time. That means you don't have to go ahead and file extensions and everything else. You can actually just give the K1 to your tax professional, and the tax professional will know exactly what they're looking at. And on the K1, it's super simple. For us, we do just one K1, right? So that's another question. Some folks who are in certain funds, and let's just say they have, properties in 20 different states, you might get 20 different K1s from that fund, right? And that's a big difference from saying I'm getting a one single consolidated K1, right? Which is what we offer. The second part of that is on the K1, the way it works is that the actual depreciation is already offsetting your income on the K1. So when you look at your actual income, it shows as a slight net loss. Again, that's not a guarantee that'll happen every year. We think we'll cover the majority, if not all of the income. But in the past 4 years, we've been, created small tax losses, have been able to cover 100% of all the income with depreciation.
Yeah, that's great. Like I said, I want the easy button on all this. So that's perfect.
You and me both.
So something else you mentioned that I wanted to ask about too is just that, the housing market has changed a lot, right? The real estate market itself has changed a lot in the last, just 5 years even. Where do you see, like, obviously you're directing a lot of investments, your company is directing a lot of investments right now. Where do you see that going? Like, is it all toward building new housing? Are you doing conversion projects, taking offices and converting them to apartments? Like where's the money going right now that you think is going to be the future for the next couple of years?
Yeah. I'll start by saying new construction is a great, place to be depending on what you're building. So again, you're right. You go back 5 years ago, almost everything being built was for sale, right? Interest rates were low, lending and, just capital liquidity was available to everyone. So there was a lot of churn and a lot of turning over, a lot of flipping of homes, right? And people did well at it. However, once the liquidity became dry, go back, 2 or 3 years ago when markets started to change, right? You saw less of that, you saw less sales, and you saw a lot more of the start of build for rent, right? Now, it always had been there, but dictated by the market and by the availability of liquidity, most people, right? Because when you're buying a property, you got to think of what your exit is, right? And if your exit isn't going to be there, you don't think you could sell that property within a quick period of time and get the return you want, right? It's almost hard to make that pencil. And you can make anything work, right, in a spreadsheet. It's how do you actually make it happen in reality? So that's been the reason why you've seen a lot of that of the market convert to build for rent. For us, right, being in housing, especially in what we'll call attainable workforce housing, right? Because what we're in is all impact investments, and we're not talking about government sponsored or LIHTC. These are just affordable homes that we're building for. Think of your average teacher, your nurse, your firefighter, right? That works in a community but can't live there because they can't afford it. So what we're trying to do is build more housing that's affordable. In today's market, you go back 2 years ago, it was probably like a $5 million gap, or excuse me, 5 million unit gap, right? Between what was available and what was needed. So again, there's so much more demand than there is supply. You come now to where we sit today, that number's around 7 million. So it's growing by almost 1 million units a month, where the gap is getting worse and worse. And if you look at, again, today, right, construction starts are almost non-existing, right? So where's that going to come from, right? In the next 2-3 years, right? When people are looking for those units, they're not going to be available. We're still building, right? But we can't build it fast enough. We've got 10,000 units coming out. You need millions in the market. So for one, it's a great, when you think of investment 101, supply and demand, it's a great space to be in, right? Yeah. Attainable workforce housing. I don't think there'll ever be a period where we'll ever see that gap ever, come back. Maybe a little bit, but I don't think it'll ever disappear, which means there's always going to be demand. And if you think about, just again, I'll use COVID as a good example. Our occupancy was about 97%, and it went down during COVID to about 94%. And that was mainly because of eviction moratoriums, right? Think about all these other asset classes. Take hotel, take retail, take hospitality, office space, right? They would kill for a 94% occupancy in good times, right? Let alone, tough times. So that's the resiliency of the attainable workforce housing space, is that there's always going to be demand, especially in hard times. So we like the space. We love it. We think, that's a big shift in the market, right? Because you could make rents, affordable. And the way we define that affordability is the 30% threshold of the average median income. So above 30%, we consider that unaffordable. Less than 30. And we try to stay, call it in the 25% range, plus or minus a little. Usually it's in the low to mid 20s, very affordable rent. And you know what? When you make rents affordable, people pay.
Yeah, I like where you're going with the impact investing, because I think real estate can oftentimes feel cold and sterile, where it's dollars in and then hopefully more dollars out, and it's so focused on the dollars. But I know one thing that Nate and I really enjoy about the single family investing is taking that uninhabitable property and fixing it up, and now it's inhabitable. It goes from an eyesore to someone can live there, and it's safe and respectable, and that feels good. And so it sounds like a lot of what you're focused on through the impact investing is that same kind of strategy, something that feels good along the way. So I'd love for you to unpack that more if you could.
Oh, absolutely. And that's a huge part of, and we didn't talk about this yet. We have over 3,000 investors in our fund, 3,200 to be exact, where we sit today. The reason we, have that many investors is because a lot of people, to your point, want to know that they're doing some good with their investment as well. So we like to say, not only do we do well, for our investors, but we do good in the community. And it's all about building thriving communities. You'll hear that a lot at DLP because, again, I love what you said, David, about, fixing up the eyesore and really just making places habitable. So the housing for us in building thriving communities is just one component. We have like 10 different components to what it means to build a thriving community, right? Because what you want is connections between communities. We always talk about, how do you know if it's a thriving community? Well, if someone has a child in the middle of the night, right, and they have to run out in an emergency, can they walk next door and knock on their neighbor's door and ask them to watch their kid?
Mm-hmm.
You'd
Mm-hmm.
believe it or not. I mean, 90% of communities, the answer is no.
Yeah.
Right. And that's just, there's no connection. So building those connections. So for us, it's making it affordable, making them great places people want to live in, adding enrichment programs, right? Bringing in just simple things where they can connect with each other. We do 2-year leases rather than 1-year leases, right?
Mm-hmm.
Keep people in there longer, let them develop. They don't have to move, right? We give them all kinds of different programs to really help them kind of form those bonds, help each other out. So it does make a meaningful difference when you do that. People are less apt to, trash out the place, right? They're going to stay in there longer. For us, we want residents on average to be in our communities for 8 years. The average today is about 15, 16 months, right? That people are in their apartments. So it's a big difference in how you look at it. And what we've proven is, you know what? You don't have to take concessionary returns to offer impact investments, right? We hear that so often from folks. Hey, we're going to do impact investments, but we're going to give you a 7% return, right? Well, that's not true. You don't have to have concessionary. We've been delivering double-digit returns in all our funds. I'll give you a good example. Our lending fund, which is the what I'll call maybe the least impactful even of our funds, because again, it's lending to other real estate operators that are trying to make that same impact, but we can't dictate them to do what they want, right? But what we try to do is align ourselves with folks that are making an impact. And that makes a difference because we can choose to who we lend to. So again, that fund has been out for 10 years, since 2014. It has never had an annualized monthly return. So on a monthly basis, annualized, never had a return less than 10% in any month ever over 10 years.
Wow.
So,
awesome.
I mean, again, you don't have to have concessionary returns. And then within our housing fund and our building communities fund, right, we can invoke all those programs and really build those thriving communities. And you know what? People love to live there. People want to stay there. And it really starts building. And it's affordable, right, which is a meaningful part of making that impact.
Yeah, I really like that. I just like taking it beyond the numbers for a second. I think that's super important. So appreciate you sharing that. So Rich, I want to go to our final infusion questions. 3 questions we ask every guest on the show. Get your take, see what your thoughts are. So the first one is, what's one tangible strategy that you use to make sure that investing works hand in hand with your career? How do you avoid getting distracted by the day in and day out grind? Like what keeps you on the outside looking in?
So yeah, for me, I mean, it's really just, again, I think part of it is, and you'll have to forgive me because I'm a faithful person, and it is truly about aligning myself with making an impact. I've gone from, my point in my career where it's more about making a difference and trying to go from success to significance. So I'd like to think that, yes, I can still get good returns, but I can also do good in the community. And there are so many good investments, not just DLP. There are investments out there that you can find that are doing well in the community, and internationally, all abroad. So that's the first thing for me is just, you know what? I like to grind. I like to work hard. But at the same time, I like to think that, you know what? I have my passive investments that are doing well and are doing good for me.
That's great.
I like that a lot. That's that success to significance. That's powerful right there.
I think wrote that down too.
Yeah. Second question is, what's one resource that's been most helpful to you on your real estate journey, whether that's a book, a podcast, a person, author, website? What would that be?
Oh, so many good things out there. You know what? And again, this is not a shameless plug. I'm going to say it because I think, if you guys haven't met Don Wenner yet, the CEO and founder of DLP, he wrote 2 good books. The first one he wrote was about 5 years ago called Building an Elite Organization. And it kind of goes through all the fundamentals of what we do and how we do it. So it's not just the investment in real estate, right? Which we do well, right? But it's how do you run a good organization? So you have a lot of good real estate operators out there that cannot run a company, right? It's unfortunate. But this is about the disciplines, about the things you do while you're investing in real estate, while you're doing all of those great things that we all want to do and want, our returns from. It's how do you continue to grow the company, but grow it profitably, scaling it, and doing things that are very disciplined. So it's a great book from that perspective, and I recommend it to all. And then he wrote a separate book about a year ago called Building an Elite Career, which is more for individuals and how to apply those principles to your daily life.
That's great. Those are definitely ones that have not been recommended, so thank you.
All right, excellent.
All right, and then the last one, what's one piece of advice you'd give to a pharmacist or other working professional contemplating a start in real estate investing?
Due diligence, due diligence, right? I mean, it's tempting to just dive right in. I think if you take the time, it doesn't take a lot of work. We're not talking about, hey, I've got to spend months, diving into this. No, you just have to, create a quick checklist, check with guys like you, right, that do this for a living, and say, what are the things I need to know and ask, right? People have done this way before us, right? Leverage what they've done. Get the questions, right? Poll 10 people. You'll probably get 10 different questions. Some of them might overlap, right? But at the end of the day, you'll come out with 25 questions, of which maybe 15 will matter to you. And you know what? Don't hesitate to ask those 15 questions, right? Ask them. If you're not satisfied with the answers, move on. That's my fit. You just move on to someone that does satisfy those answers, and you'll be in good shape.
I love that. Finding the win-win and the fit in an investment. I think that makes a lot of sense. For people looking to learn more, where can people find you?
So you can actually just come and you could either email us at info@dlpcapital.com, or you can reach me directly, rich.delgado@dlpcapital.com. And again, on our website, dlpcapital.com, there's an investment button. It has all of our investment fund tear sheets. It has a good funds comparison, which puts all funds side by side. We have our quarterly report. There's just tons of information on our website about not only the investments, but then events that we host. So we are very, like I said, very transparent and communicative. We do, a few webinars a month, keeping our investors updated on, the real estate markets, what's going on with the different funds. We host events, live events. We do dinners in many cities. September is going to be a really busy month. So we're going to probably be in like a half a dozen cities for different events and different dinners. But then we host two big events every year, one in November here in St. Augustine, and then one in June, which can be a different city. This summer, we just did it in Pigeon Forge. It was called Building an Extraordinary Family Event. So again, sorry if you're looking to just learn about real estate. We really do. This is about pouring into our community. We really help them out. We bring speakers and bring content. We had content for all ages, from kids to teenagers to grown kids, grandparents. So it was a beautiful event. That was Pigeon Forge. Next summer, we're going to be in Asheville, North Carolina. So again, another family event that we'll host there at the Omni Grove. But again, I say, reach out to us. We're happy to tell you about what we do, why we love doing it so much. And again, we love to really serve our investors. Believe it or not, 70% of all of our investments come from existing investors adding to their positions. So I think, we're doing something right. I think if we continue to have additions coming in. So yeah, but I appreciate, the time this evening, gentlemen, and look forward to working with you guys more in the future as well.
Yeah, we appreciate your time, Rich. You're an absolute wealth of knowledge on this stuff, and it's just great to be able to talk to you and spend the time. So we appreciate you joining us, and I'm sure we'll have opportunity to talk to you guys in the future. So thank you.
Beautiful. Have a blessed evening, gentlemen.
Thank you.
Thanks so much. Thanks for listening to the YFP Real Estate Investing Podcast. If you like what you heard in today's show, please leave us a review and subscribe to the show so you never miss an episode. If you have a question, know someone that would make a good guest, or want to connect with us, head on over to yfprealestate.com and join the growing YFP Real Estate Investing Facebook group.
As we conclude this week's episode of the YFP Real Estate Investing Podcast, an important reminder that the content of this podcast is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in this podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with their financial advisor with respect to any investment. Furthermore, the information contained in our archive newsletters, blog posts, and podcasts is not updated and therefore may not be accurate at the time you listen to it. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer.
Thank you for your support of the YFP Real Estate Investing Podcast. Have a great rest of your week.